ESOP valuations under increased IRS scrutiny. An employee stock ownership plan, ESOP, can facilitate the transfer of a business to the owner's children or employees over a period of years in a tax-advantaged way. However, the IRS recently issued a statement warning businesses about a range of compliance issues related to ESOPs and announcing plans to ramp up compliance enforcement. The IRS has identified numerous issues, such as improper valuation of employer stock, prohibited allocation of shares to disqualified persons and failure to follow tax law requirements for ESOP loans, causing the loans to be prohibited transactions. In light of this warning, business owners who are interested in pursuing an ESOP should seek the advice of business valuators and other professional advisors to ensure compliance with the rules. Here's some critical information when deciding whether an ESOP is the right strategy for a particular business. Differences from buyouts. An ESOP is a qualified retirement plan that invests mainly in company stock. While an ESOP involves transferring ownership to employees, it's distinguishable from a management or employee buyout. Unlike a buyout, an ESOP allows owners to cash out and transfer control gradually. During the transfer period, owners' shares are held in an ESOP trust and voting rights on most issues, other than mergers, dissolutions and other major transactions, are exercised by the trustees, who may be officers or other company insiders. Mandatory valuations. The fair market value of the sponsoring company's stock is critical, because the DOL specifically prohibits ESOPs from paying more than adequate consideration when investing in employer securities. In addition, because employees who receive ESOP shares typically have the right to sell them back to the company at fair market value, the ESOP essentially provides a limited market for its shares. The Employee Retirement Income Security Act of 1974 requires trustees to obtain business valuations by independent professionals to support ESOP transactions. The owners also may decide to obtain an informal valuation before the ESOP is set up to help evaluate whether it's a feasible exit strategy. Costs and limited availability. Another disadvantage is that ESOPs are available only to C&S corporations. The National Center for Employee Ownership estimates that more than half, 55%, of ESOPs are in S corporations. But they have different rules than C corporations when it comes to ESOP contributions and tax treatment. Limited liability companies, LLCs, partnerships and sole proprietorships must convert to the corporate form to take advantage of an ESOP. This raises a variety of financial and tax issues. We can help. Valuing stock held by an ESOP is an ongoing challenge for the fiduciaries who administer it, especially when the sponsoring company is privately held. Hiring a qualified, independent business valuation expert is critical to withstand IRS and DOL scrutiny.